Good morning, guys. Matt from Blaze Capital here. This is actually my third time making this video. The last one was done without sound, and then the one before that I just butchered it. So third time's a charm, hopefully. Today I'm going to talk to you guys about credit spreads. I had a couple requests, and I finally looked into them, and they're actually pretty interesting, and I'm starting to use them a lot more in my own trading. So basically what a credit spread is you're short selling an option contract, either a put or a call, and that's going to be closer to your current trading price. And then you are buying the put or call, depending on what you're doing, in the further out of the money in order to cover yourself, just in case you're completely wrong. Excuse me. And you have a max profit and you have a max loss, which is really nice. So I'm going to go over a couple of the trades that I have on right now. So we're going to go over CI to start. So what we did here was you go out usually around 30 or 45 days or so, and you are going to sell the contracts closer to the current price and then buy the ones above it. So you have a max loss of $700 and a max profit of $300. Now this doesn't sound great. But you're banking that you're going to be right on the direction. And the nice thing about credit spreads is even if you're not right on the direction, as long as it stays below the strike price, you're going to get your full 100% credit. And you have a max loss and a max profit. So we have a max profit here. So this one, I have a credit of $1.50 per contract, so $300. And the max loss would be if we went to above 170 at expiration. So that would be $1,000 loss, and then minus your 300 credit. So you have a $700 max loss. So this is a bearish spread because we're betting that the stock is not going to go up. So if we look here, we have our call that we sold here at 165, and then the call that we bought here at 170. So this setup is a bear flag here, staying below the moving averages. It's a 5-10 moving average cross, and then likely once it breaks this 20 simple moving average, it should drop, a bit, and then we'll collect our profit. So with this, we sold the credit for $1.50 per contract. And then the idea is to buy it back for a cheaper price. So you're going to get theta decay closer to expiration, so the time value of the option is going to decrease, which is our first way of making money. Secondly, you're going to get a delta change, which is going to be larger for the one that's closer to in the money. And if you're right on the direction, so if this breaks down, we'll get a faster decline in the value of the 165 than we are the 170, and then the difference is going to widen, and then we can buy it back for a lower price than what we sold it for. So normally try and close out around once about 50%. This just gets the money in your account, and then you can open up another trade. With these ones, you want to be careful, like don't do them near earnings or anything like that, just because, yeah, like you can get your max loss really quickly if you get a large move. Excuse me, guys. And then, so yeah, normally I'll put in the original sell order, and then as soon as the sell order hits, we put in a buy order for 50%. So for this one, I have a buy order in for 75 cents, which will give me $150 profit, and then minus commissions, which is around $10. So you'll net about 140 on that, 130, sorry, on that trade, which is pretty good. And the nice thing is you don't have to babysit these trades as much. You just kind of check in on them once a day. You know what your max loss is, and you know what your max profit is, and then you're just banking that no matter what, the time waiting of the option should decrease closer to expiration as long as it's not really far in the money. So that's really nice. What else can I talk about? So we have I'll go through the spread calculator here. This is on optionsprofitcalculator.com. So this is my CI. It has my 2 strikes here, and then it shows you your max profit, max loss at different days. So as I was mentioning, our max loss is $700, max profit is $300, and then the various prices at the various dates, they're going to give you different values. So if we move really quickly so if it drops down to like the 150 mark, you'll realize 50% max profit in like a week or so. If not, you might have to hold on to it a little bit longer. The other thing to mention is you just got to be careful with how your orders get filled. So this Beyond Meat one I have, I was upside down on this one a really long time because I it the trade is a limit trade for the total contract. So you don't necessarily know where each put's going to get filled. So with this one, I had a high price for the one that I bought, and then a low price for the one that I sold. So I was upside down on it for about a week and a half before it finally flipped positive on Friday. And then these ones, you also want to close them if you don't get filled right away. So I had what was it? I had an iron condor on Chipotle, and I got filled like a really bad fill, and I was pretty upside down on it. So I closed that one early for about a $200 loss, and that's just my own fault for not closing the order. So there's still mistakes to learn, but overall I'm liking them quite a bit. So this one I put on, I think, Wednesday. So I sold it for 82 cents a contract. And then the idea is to buy them back for 41 cents a contract. So we're already profitable about 34 cents there. And that's just in a couple days. So if I were to cover that, I'd make 34 bucks minus commissions. And just like your probabilities are usually pretty high on these as long as you don't even have to be right in the direction. So like you just have to be right that it's not going to go above or below the price that you sold, and you're banking on theta decay. So even if you don't necessarily have to be right, you just don't have to be super wrong. So the risk of directionality isn't quite as important as if you're in a long call or a long put, because those you're going to get the theta decay. So that in this situation, this is what we're banking on, is the theta, and then ideally delta decay if you're right on the direction. So the overall strategy is pretty good. I like it because you don't have to watch it as much, and they're pretty nice for swing trades. So just I'll have some more data on these as we go. I've been posting stuff in Trello, so you guys can go look at some of that. And then we'll go over debit spreads and iron condors and iron flies and all that kind of stuff. So with these, the idea is to trade them like pretty frequently, and then cover them pretty frequently, and just realize your gains. And then they're not very capital intensive, so you just have to be able to cover the max loss for these for each trade. So it's usually around like 500 or 1,000. So you can get like quite a few trades on at a time, but just be careful because you don't want to have too many and have them all be wrong and have to cover all of them. So just yeah, you can play around with them, and the overall risk isn't quite as bad because you have a max profit and max loss. But the key is having low commissions, because if you're paying like 20-30 bucks commissions for these kind of trades, you're only going to want to take really high credit, or else you're going to just be paying all your money in commissions. Another thing to mention is, in general, you want to try and get as high of a credit as possible, because that gives you more of a buffer. So when you're setting your limit, generally try and go around like 50% in between the bid and the ask, or slightly above that, and then try and get as much credit as possible. Just you don't want to have it sitting there and not get filled too long, though. And then I usually just put my bid order back in right away, and then just leave it good till cancel. And then they'll fill whenever they do, and then you have a better probability of it actually filling if you have the order up already, rather than having to watch all these positions all the time, which is nice. So yeah, in summary, you're short selling an option, you have a max profit and a max loss. You want to get as high credit as possible and buy it back at the lowest debit as possible. And yeah, so puts are obviously for selling puts is obviously if you think it's going to go up, and then selling calls is if you think it's going to go down. And then you can put in more complicated strategies if you think that the stock's going to stay flat and all that kind of thing. Another thing to mention, if the IV, the implied volatility, is higher on these contracts, then you're going to have a better probability of getting more theta decay, especially if it goes the opposite direction, which is good. But even if you're on a lower IB with credit spread specifically, they're not as important as they are with iron condors and those kind of strategies, because you're kind of banking on directionality here and theta decay. So awesome. I don't think I have anything else to go over here. So yeah, I know this is a complicated topic, so just feel free to message me if you guys have any questions. Awesome. Thanks, guys. Let's go make some money.